Welcome back to Miller Momentum. If you've been navigating the financial side of YouTube lately, you've almost certainly encountered the channel Investing Simplified, hosted by Professor G. With nearly 400,000 subscribers, the professor has built a massive following on a very specific promise that investing can be simple, stress-free, and incredibly profitable if you just ignore the noise and buy three specific kinds of ETFs. He calls it the new three-fund portfolio, claiming it crushes the traditional models and sets you up for life. It sounds perfect. It sounds easy. But here is the uncomfortable truth that we're going to talk about today. Simplification, when taken too far, can become a risk multiplier. In this video, we're going to take a rigorous, objective look at the Professor G three-fund ETF portfolio strategy. We're going to break down the mathematics he ignores, the history he overlooks, and why his rejection of bonds and international stocks might just be the most dangerous financial advice you could follow in 2025, 2026, or any other year. Today, I'm not going to argue against Professor G's buy and hold, to be clear. In fact, I believe in it. But I'm going to prove that what you hold matters. Professor G's portfolio is built for the economy of the last 10 years. But if the next 10 years look different, which they probably will, his simple strategy could lower your gains, increase your risk, and even cost you a decade of returns in the worst case scenario. This is Investing Oversimplified. First, a disclaimer. I am not a financial advisor, and this is not financial advice. I'm just a guy on the internet comparing historical performance and professional investment information from sources like Vanguard, Jack Bogle, and Morningstar with Professor G's strategy and recommendations. The content in this video is for entertainment and educational purposes only. Past performance, including for the S&P 500, is not indicative of future results. Investing always involves risk. Do your own research. First, let's steelman the argument. We want to represent the professor's strategy accurately before we critique it. Based on his most recent videos for 2025, Professor G advocates moving away from the classic Boglehead portfolio. Instead of owning international stocks or bonds, he proposes a 100% U.S. equity structure divided into three buckets. First, the foundation, roughly 33% in VTI or VU to capture the broad market. Second, the safety bucket, 33% in a dividend ETF like SCHD, which he claims replaces the need for bonds by providing cash flow. And third, the growth bucket, 33% in a fund like QQQM or SCHG to capture the upside of big tech and AI and other growth sectors. The logic is seductive. U.S. companies are global, so who needs international? And bonds lose money to inflation, right? So why not own dividend stocks that grow their payouts? It feels intuitive, but mathematically, it's a house of cards. The technical name for it in portfolio theory is actually naive diversification. This doesn't mean Professor G is naive, no, but instead, naive diversification refers to the idea that simply buying things that are different will help you. Why? Because all three of these funds generally rely on the exact same thing to go up. The large cap US economy and the US dollar have to be doing well. If the large cap US market takes a hit, like it did in the 1970s or the 2000s, all three of these funds crash together. You don't have a safety net. You have three holes in the same net. You have a defective trampoline. This is concentration disguised as diversification. The reason why the three-fund portfolio behaves almost identically to the S&P 500 is because it essentially is the S&P 500. To be truly diversified, you need to buy things that are different and that move differently from each other. You might feel diversified with VTI, SCHD, and QQQM, but let's look under the hood. VTI, the total US stock market ETF, literally owns every stock found in SCHD and QQQM. When you buy all three ETFs, you aren't diversifying your risks. You are concentrating them. You are essentially rebuilding the US stock market, but tilting it heavily toward the extremes on either side. Massive tech and growth exposure on one side and defensive stocks on the other. This creates what we call the barbell risk. In a functioning market, value and growth might balance each other out, but in a liquidity crisis or a stagflationary shock, correlations go to 1. In 2022, VTI fell. SCHD fell. QQQM fell. There was nowhere to hide. You weren't diversified, you were just 100% long the US dollar and large cap US corporate earnings. But perhaps the most potentially dangerous advice on the Investing Simplified channel is the recommendation to replace bonds with dividend ETFs like SCHD for your safety bucket. Professor G argues that because bonds can lose value, as they did in 2022, they are broken. He suggests SCHD is better because it pays you to hold it and continues to grow all the while. This is a fundamental misunderstanding of capital structure. A bond is a legal contract. A company must pay you or go bankrupt. A dividend is a choice. A company can cut it at any moment to save cash. In 2008, banks slashed dividends. In 2020, energy companies slashed dividends. When you replace bonds with SCHD, you are replacing an asset with a correlation that's usually low to the stock market with an asset that has a correlation of at least 0.85. You are removing the structural beam that holds up your house and replacing it with more drywall. It looks pretty until the earthquake hits. The substitution of bonds with dividend stocks also violates what's called the Modigliani-Miller theorem, which states that in a frictionless market, dividend policy is irrelevant to the value of the firm. Professor G's focus on getting paid, getting cash flow, ignores the total return perspective. There is no practical difference between a company paying out 1% of its stock as a dividend and you selling 1% of your stock in the company. The value of your holdings effectively goes down 1% either way. I think it's best to show you visually why replacing bonds with dividend ETFs is not the best idea for most diversified portfolios. So right here in this testful.io chart, you can see long-term US Treasuries in purple. You can see US aggregate bonds in a kind of a teal green. And right here I'm showing the time period from 1997 to about 2013. So a good 15-year chunk. And you can see the correlation between growth and value in the S&P 500 and how bonds during this difficult 15-year window performed exceptionally well compared to stocks. And these 15-year windows are actually not that uncommon. The predominant historical pattern has been that stocks are on again, off again, for the USA at least, about every decade. So you'll have a good decade and a bad decade, a good decade and a bad decade. So keep that in mind. Let's put bonds aside and move on to stocks. Professor G tells you to buy VTI or VU because that way you'll own everything. Well, with VU, at least you'll own everything when it comes to US large caps. But do you want to own everything? When you buy VU, you are forced to own companies that are dying, failing, or drowning in debt simply because they are in the S&P 500 index. You are dragging an anchor. This is where Miller momentum differs. I use momentum ETFs like SPMO. This isn't active trading. It's a smart passive investing approach, rules-based. It automatically scans the S&P 500, keeps the top 20%, the top 100 stocks that have been winning recently, and kicks out the ones that are losing. You still just buy and hold the ETF, but inside the fund, the losers are being ruthlessly cut for you in an automated way. So why settle for average returns from your equity allocation when you can systematically harvest the winners by focusing on the momentum factor? So here's a comparison of the Mid-Cap 400 Momentum Index, which has the same methodology as SPMO. It takes the top 20% of best performing stocks from the Mid-Cap 400 Index, so that would be about 80 stocks, with the best performance over the past 12-month period. And it looks at this on a semi-annual basis. You can see it compared to the base Mid-Cap 400 Index. Momentum, I should stress, is a long-term strategy, but the empirical research and evidence is that it inevitably tends to outperform its base index by about 1 to 2 percentage points after about a 20-year window. And you can see this playing out very well here from 2005, which is when XMMO debuted, the Mid-Cap 400 Momentum Index, to the present day. You can see how it has outperformed its base index, so it can really pay to pick the recent winners and drop the recent losers. So, what is the alternative to Professor G's 3-fund ETF portfolio? Well, there are quite a few good alternatives, even including default target date retirement funds that are offered by most employers, that are offered by Vanguard. However, I'm going to talk about my approach, the Miller Momentum Portfolio. It is also a static buy and hold strategy like Professor G's that can truly adjust to an individual's risk profile by resizing the funds. You set these percentages and you leave them alone, except for quarterly rebalancing and semi-annual or annual tweaking of the equity ETF percentages to get them to match the global stock market. But look at the components. I don't just own US stocks. I own global momentum stocks because sometimes Europe or Japan outperforms the US. I also own emerging markets, with autocratic regimes excluded, of course, to get at emerging market momentum indirectly by investing in free market societies. But most importantly, I own things that aren't stocks. See that slice labeled CTA and Chaos? Those are my insurance policies. I've also got gold. When the stock market crashes, these funds are designed to go up. Professor G's portfolio has zero insurance. My portfolio has insurance built in. The biggest hole in Professor G's strategy is that he relies on time to heal all wounds. He says if the market crashes, just wait 5 years. But what if you were retiring? Or what if the market takes 14 years to recover, like it did in 1929 or 2000? Do you just have to fall back on 3 years of savings in your emergency fund and hope for the best? In the Miller Momentum strategy, we allocate to managed futures using the CTA ETF, or DBMF, or another managed futures ETF of your choosing. This fund uses computers to track trends in commodities, currencies, and bonds. In 2022, when stocks and bonds both crashed, managed futures soared. By holding this alongside your stocks, you smooth out the ride. You don't have to panic sell because part of your portfolio is actually making money while everyone else is losing. I also allocate to Chaos, CAOS, a tail risk ETF. Think of this as fire insurance for your portfolio to safeguard it against sudden and severe drops. Most years, it acts just like an aggregate bond fund, including sensitivity to interest rates for better or worse. But if the market crashes 20% or 30% in a month, a black swan event as they call it, CAOS is designed to spike in value. This allows us to rebalance strategically each quarter. We sell the expensive CAOS and buy cheap stocks at the bottom. Professor G's strategy forces you to ride the elevator all the way down to the basement and pray it comes back when the market crashes. I prefer to have a parachute for sudden drops, a holding that switches dynamically between the behavior of, say, long-term treasuries and intermediate-term bonds as needed. Another huge risk with investing simplified is home country bias. Professor G bets 100% on the USA, and I can respect that. It's patriotic. And sure, the US has been the winner recently, but in the 2000s, US stocks returned about 0%, while emerging markets boomed. You can't just exclude the rest of the world because you're proud of your own country. The Miller Momentum strategy includes IDMO, which is International Momentum Exposure, and FRDM, which is the Freedom 100 Index and gets at emerging market momentum indirectly. We aren't guessing which country will win. We own the momentum factors globally. If the US stagnates and Europe takes off for a while, IDMO automatically adjusts. I don't have to read the news. My portfolio adapts automatically. Lastly, Professor G says volatility is the price of admission. That's easy to say on YouTube. It's hard to do when your life savings is cut in half. The Miller Momentum strategy is designed for behavioral robustness so that I won't panic sell. By including uncorrelated assets like gold, managed futures, and tail risk, we reduce drawdowns. When your portfolio falls less than the market, it is infinitely easier to stay the course. I don't rely on willpower so much as I rely on math and human psychology. And don't get me wrong, investing simplified is a great starting point for beginners who have a high conviction that US outperformance will continue and who are comfortable in investing primarily or exclusively in US large caps. But if you are serious about preserving and growing your wealth with a global strategy, with a diversified strategy that is robust across many different macroeconomic conditions, you cannot rely on a strategy that assumes the future will look exactly like the past. The Miller Momentum strategy offers a sophisticated, institutional-grade portfolio design that I can manage in about 5 to 10 minutes every quarter. It uses momentum to capture the upside and alternatives to protect the downside. Stop feeling like you have to buy the market's garbage or over-concentrate in order to get performance. You can upgrade to a strategy that works harder for you. Thanks for watching. Like and subscribe to Miller Momentum.